everyone. I hope you all have been preparing really well for your exams, which is coming up in May. Today we are going to start with the amendments which are applicable for intermediate CA attempt for 2026 May. As you all know, the budget which came in 2025, the Union Budget of 2025, is now applicable for financial year 25-26, which means for AY 26-27, these amendments are going to be applicable. There are not many or a whole bunch of amendments. There are quite a few, but they are important ones. We all know the structure, how the preparation of questions are being done. They are majorly focused on the amended areas, especially when it comes to income tax, to check if the students have adequately updated themselves with the latest attempt updates. So please pay special focus as far as amendments are concerned. Please make sure you're giving a special attention to these areas because it is most likely that questions will be asked from these areas. So without any further delay, let's start with the amendments. When this budget actually came, it was being projected to be a middle class budget, okay? So anyone who is having a mid-income range, it was set to benefit them, and appropriately so. Why? Because the biggest change happened in the rates of income tax. We commonly also call it as the slabs of income tax. Now, we all know there are two regimes. One is your optional tax regime and the other one is default. As far as the optional tax regime is concerned, I don't think there has been any change in the tax rate for quite few years now. And we know why. We know very well the government wants to somehow want people voluntarily to move out to default tax regime. This budget actually nails it because now the gap is becoming so wide. The tax benefits are much more in the default that people would opt definitely for default. So there is no change of rate as far as optional tax regime is concerned. However, if you move to default, the game changes completely here. Basic exemption limit has now become 4 lakhs. So up to 4 lakhs, the tax is nil. 4 to 8, it is 5%. 8 lakhs to 12 lakhs, it is 10%. 12 to 16, it is 15. 16 to 20, it is 20%. Please note, 20 lakhs, 20%. Remember it that way. 20 lakhs to 24 lakh, 25%. And more than 24 lakhs, it is 30%. So now, there is a lot of changes here with the basic exemption limit itself being enhanced to 4 lakhs. Which means, when we prepare our computation and we do the tax computation, if there is an income criteria, we mention up to 4 lakhs as nil, 4 lakhs to 8 lakhs, 5%, and this is now 20,000. Okay? 8 lakhs to 12 lakhs, 10%, 40,000. 12 to 16, 15%, 60,000. 16 to 20, as I told you, it is 2020, yes, 2020, 80,000. 20 to 24, 25%, which is 1 lakh. And beyond that, of course, it is 30%. Please note, for every slab, there is an increase of 20,000. Even here, even here, even here, everywhere. It is the increase of 20,000, and every time the percentage increases by 5%. So every slab has a 5% increase and the tax rate or the tax amount is 20,000. Remember that when you're doing your problems and you're in a hurry to compute tax. So this is the biggest change as far as the tax rates are concerned. Let's take up the second amendment, which has happened in rebate. Section 87A. Again, no changes as far as optional tax regime is concerned. It is still 5 lakhs, it is still 12,500 resident individuals there is no change here at all. But the biggest boost have been given in default tax regime, where now the resident individuals whose income is within 12 lakh gets the rebate. Please note, the total income should not exceed 12 lakhs and the rebate amount is now 60,000. Actual or 60,000, whichever is less. Two things here. Let me just tabulate it quickly for you. With regard to special income, there is a lot of confusion. Rebate will be there, will not be there. Let's understand what happens in both the regimes. So if there is an optional tax regime or if there is a default tax regime, how is rebate going to play out in special incomes? So we have three incomes which come at a flat rate. You have 111A, 112, 112A. In capital gains, you know these are special rate of taxation is applicable here. As far as optional is concerned, they do get rebate, but not 112A. We have understood earlier even why they enjoy 1,25,000 of exemption any which ways. So no point giving them additional rebate. However, default tax regime has taken away rebate for all of these special incomes too. There is a clarification which was missing earlier and now it is very clear how much is rebate applicable to these incomes. Please be mindful of which regime are they in. There is some confusion even with regard to marginal rebate. Let me take up a small example and clarify even this here. There is no change as such in the calculation of marginal rebate except for the amount of 12 lakh which is now coming. Instead of 7, it is 12. That's the only change here. But there is some confusion. Let me clear even that. I take a small example here of marginal rebate. Let's take our total income or taxable income as 12,25,000. Okay. Now we will be doing it in two steps. Step A is finding out the difference between this 12,25,000, which is our total income, minus 12 lakh, which is your limit for rebate. We get 25,000. Let's call it as A. Step 2 is to find out tax on 12,25,000. We already know the slabs. Up to 4 lakh it is nil. 4 to 8 it is 5%. We know it is 20,000. 8 to 12 it is 10%, which is 40,000. And beyond that, which is 12 to 12,25,000, it is 15%. So it is 25,000 into 15% comes to 3,750. So if we total it up, this is going to be 63,750. We are going to call it as B. Now comes your marginal rebate. First thing, marginal rebate will be applicable only if B is greater than A. This criteria is getting fulfilled here. Definitely 63,750 is greater than 25,000. So now what is rebate or what is marginal rebate? B minus A will be your marginal rebate, which means 63,750 minus 25,000, which comes to 38,750 becomes your rebate. In other words, your tax liability will be back to 25,000. Marginal rebate is not allowed under optional tax regime, only under default. Please be mindful about these steps and I'm sure you'll get your answer right. So this is the second most important amendment which has come. Let's move on to the next chapter. There is no changes as far as residential status is concerned. So we straight away come to salary. In salary, there is a very minute or a minor change. We understand in perquisite, there is specified employee requirement. So in terms of perquisite, there is a taxation requirement. So perquisites can be categorized into three categories. One, taxable for all. One, exempt for all or tax free for all. And the third one is taxable only for specified employees. Okay, this is how we categorize our three perquisites. What are these perquisites which is taxable for only specified employee? These ones, we have a list here. Provision of sweeper, gardener, watchman, personal attendant, use of gas, electricity, water supplied by employer, concessional ticket, concessional or free educational facility, and use of motor car. So if these perquisites are given by the employer to the employee, and if the employee happens to be a specified employee, only then it is taxable. Comes a question, who is a specified employee? Three categories. Category 1, if they happen to be director of the company. Director, who is the employee, obviously a specified employee. If they are having any substantial interest, then 20% or more is their voting power and all of that, then they become, again, a specified employee. Now the change which has happened is in category 3. When the salary exceeds, it was 50,000, now it has become 4 lakhs. So when the salary is 4 lakhs per annum of any employee, that employee would also become a specified employee. Please note, it is not 50,000 now, it is 4 lakh. When we calculate this 4 lakh, there are certain amount of requirements which we need to take. For example, if there is any non-monetary perquisites, we don't add up and calculate 4 lakhs. We basically ignore them. Okay. We also ignore any section 10 exemptions. So if any exemption needs to be given under section 10, we give it. After that, we say is it 4 lakhs or not. And third, we also give them deductions. Which deductions? Standard deduction 16(1)(a). 16(2) entertainment allowance for your government employees. 16(3) professional tax. Yes, all of these deductions are also given to calculate this 4 lakhs. Then if the amount is more than 4 lakhs, they will be regarded as specified employee. And if they are receiving any of such perquisites, it is going to be taxable for them. So this amount is now undergone a change. Please be careful. It could be a tricky question even under MCQs. There is an amount even which is changed under perquisite where amount was given for treatment outside India. So first let's understand which section am I talking about. If the employer is giving any kind of reimbursement or if he is sponsoring any particular cost of the employee, it could be employee or his family who is going on any treatment outside India, staying outside India, and has to travel outside India. First, this amount is coming from the employer. Now comes the question whether it is going to be taxed in the hands of the employee or not. Here it is very clear. First thing, it has to be within the RBI limits. So there are certain limits set up by the RBI. If the amount is within that, yes, you can give them exemption. But the travel amount, exemption for travel, it will be only if the employee's gross total income does not exceed the prescribed limit. This amount is now being prescribed at 8 lakhs, which means this travel part, it will be exempt only if this employee's gross total income is within 8 lakhs. If it is exceeding 8 lakhs, it is still going to be taxable. Only if it is within 8 lakhs, it will be exempt. So please note about this limit as well. Let's move on to the next one now. So those are the two changes which have come in salary. House property, there is no such change. In terms of PGBP, there is a very small update from the MSME Act. which is having a influence here. Let's understand where is MSME even influencing us. If you can remember, we have section 43B, where deductions are allowed only on payment basis. You have your bonus there, PF contribution of the employer, railway, Indian Railways, if their amount has to be paid, all of those lists have been, government taxes, all of that. In that, there is another item which is called as any amount which is due to MSME, which is micro small enterprises. If any amount is due to them and has not been cleared within the specified time, if it is maximum of 45 days and those conditions met. So now for the purpose of this definition, now who will be a micro enterprise, who will be a small enterprise, there is a small update under the MSME Act. Let's see this. If the investment in plant, machinery and equipment is within 2.5 crores, then it's called a micro enterprise. If it is within 25 crores, it is referred to as a small enterprise. And the turnover here should be within 10 crores for micro enterprise and within 100 crores for a small enterprise. So these entities are entitled to become micro and small. If anyone else is making payment to them, they are subject to 43B. Please be very clear here. So only this is being given under PGBB. Capital gains. Let's take up this one now. If there is any long-term capital asset, which is fetching any kind of long-term capital gain, there are different exemptions that can be claimed. One such exemption is investing in capital gain bonds and getting the exemption under 54 EC. So what happens here? We can invest up to rupees 50 lakhs within 6 months and claim this amount under 54 EC. There have been already 4 bonds which are notified here. What are they? NHAI, National Highway Authority of India, Rural Electrification Corporation Limited, Power Finance Corporation and Indian Railway Finance Corporation Limited. All of these 4 are already issued. Now we have 2 more in this list. Let's understand what are they. Housing and Urban Development Corporation Limited, HUDCO, even that is being added, and IRDEA, Indian Renewable Energy and Development Agency. So this is the 2 addition which is come. If your question mentions about these 2 bonds, even they are eligible for 54 EC. Please be very clear. It could come for your capital gain problem, just to check you out here. Okay, so this is the amendment which has come for capital gains. Let's move on to chapter 6A. In other sources, we don't have any other amendments. So I'm straight away heading to chapter 6A. We have a small amendment in 80CCD1B. Now what is this? Before I even head there, let's understand what is it. We have a section called 80CCD which gives a deduction for any kind of national pension scheme contribution. If the employer is contributing, it gets deduction under 80CCD 2. First it is taxed under salary, then this deduction is given. If the employee is contributing, they are eligible for deduction under 80C itself. Sorry, 80CCD 1. 80CCD 1 they are eligible, which, if you recall, comes under 80C plus 80CCC plus 80CCD1, this equation. So all of this put together cannot exceed 1,50,000. Yes? If the employee is contributing more, they can also claim under 80CCD1B up to additional amount of rupees 50,000. So this 50,000 is over and above this 1,50,000. Can we claim first 80CCD1B and then the balance in 80CCD? Yes. 80CCD1? Yes, it is allowed. Now what is the amendment here? This is already there. Amendment is, we have one more instrument added under 80CCD1B. In case any parent or guardian want to invest in NPS Vatsalya account for their minors. So basically it is an NPS account for their minors. If anyone wants to invest, then they are eligible for deduction under 80 CCD 1B. So we're talking about Vatsalya account, which is for minors, and we're talking about employee additional contribution. Okay, please remember, aggregate amount of deduction is 50,000, not individual. Put together 80 CCD 1B gives us 50,000 of deduction. Yes, even here there is an exemption, partial exemption for withdrawal, which is given under section 10(12)(b). So if there is a withdrawal by the parent or the guardian to the extent of 25% of contribution is allowed as exemption. So if you've made a contribution of rupees 1 lakh, up to 25%, which is 25,000, can be withdrawn without any taxation. However, if withdrawal is made on the death of the minor, it is fully exempt. So this is one change which has come under Chapter 6A, 80 CCD 1B. There is one more amendment here, which is called as Unified Pension Scheme. Now, what is this Unified Pension Scheme? For the government employees, they also have this National Pension Scheme, and now they have a Unified Pension Scheme. How is it different? UPS or Unified Pension Scheme is more like a guaranteed return kind of a scheme. NPS is to a certain extent having even market exposure. So Unified Pension Schemes is like your FD. It gives a guaranteed return. Now what is happening here? If any government employee wants, they can switch without any amount being taxable. From NPS to UPS, you can switch. In fact, the treatment of UPS is also very similar to NPS. They can withdraw up to 25% and they get all other similar treatment like NPS. Yes, so this is as far as Chapter 6A is concerned. The next amendments would be with regard to TDS. TDS has a whole host of amendments, but point to be noted is that it's only in one area where the threshold limit has been increased. Why? What's the need of increasing it? Well, if the slabs have been increased, it is more likely people will now be ending up paying less tax, and therefore this was very much required to compensate it. It's got a domino effect. Just because the slabs have been increased, this effect has come into picture. Okay? Let's take it up one by one. 193, interest on securities. Now here, any interest, please note it is about any interest which is on securities, any kind of bond, anything, any interest coming in here, the limit is 10,000 rupees. For 194, which is on dividend, coming from equity, we know that income coming from UTI also has a close link here. It will come later, but please remember so that it is easier. Here the limit is enhanced to 10,000 again. It is if it is given to an individual shareholder by mode other than cash. For any other case, of course, no threshold. It is only for individual that we have a limit of 10,000 now. The next one is come to 194A. Interest other than interest on securities. Now we are going to divide 194A in two categories. Let's take it up in two categories. Category 1, if the interest is paid by bank, cooperative bank or post office. If they are making payment of interest, then we'll take it as, see, this is your bank, cooperative bank and post office. If they are making payment of interest, then it is 50,000 of limit. But if the person happens to be a senior citizen, it becomes 1 lakh. So it is 50,000 aggregate amount of course. And if it is a resident senior citizen, it is 1 lakh. If it is by any other case, it is 10,000 rupees. Please note, this is your change, okay? 10,000 for any other case other than bank, cooperative bank or post office. So in this case, it is for a regular individual, this is for a resident senior citizen. And this is if the payment is done by any person other than bank, cooperative bank and post office. This is as far as 194A is concerned. 194B and BB. 194B is your lottery winning, card game, gambling, etc. BB is your horse race. Please note, now it is with respect to single transaction and the amount is 10,000. It is not possible for them to always keep a track, which lottery ticket is won by whom, how many times in a year. So therefore, it is come for a single transaction. So every single transaction which exceeds 10,000, they have a TDS obligation. Same thing goes here for BB as well. Let's take up the next one, which is all your commissions. So 194D, insurance commission, 194G, lottery ticket sale commission, and 194H, every other commission in brokerage. The amount here is now become 20,000. Please notice the pattern, it is 20,000. In fact, your rate is also similar here, except for a change here. I think it's 2% everywhere else. Try to bundle them up and study because it becomes much more easier. So commission have a similar threshold, 20,000. Of course, it depends which commission will come under which section. Next one is with regard to rent. As far as rent is concerned, it has now become 50,000 per month or part of a month thereof. So if the amount is exceeding 50,000 per month, we are not bothered about the entire year. It is now come to per month. So maybe they are paying rent only for 2 months and they are paying 70. Still TDS is going to be applicable. Please be careful here. It is 50,000 per month or part thereof. This is 194I. 194J. We know 194J has 5 categories. You have professional services or professional fee, technical fees, royalty, non-compete and director's remuneration. So, professional fee, technical fee, royalty, non-compete fee. This is in one side, and we know director's remuneration comes on the other side. Why? Because here we are bothered about the threshold limit. For director's remuneration, there is no threshold limit. This limit has now become 50,000 individually. It was earlier also individually, even now it is individually. So 50,000 for each category. Not applicable for director payment. Okay, for each category it is 50,000. We spoke about 194K where income is coming for the units. We're talking about basically any kind of dividend given by mutual funds, any kind of income by unit funds. Yes, so that is also 10,000 because you could relate it to your 194. 194LA, which is compensation on compulsory acquisition. Here, this limit has become 5 lakhs. Please note, this has now become 5 lakhs, okay? This is as far as TDS is concerned. Let's move on to the next one, which is TCS. If you recall, TCS has one provision where it says if a motor car with a value exceeding rupees 10 lakhs is being sold, the seller will have to collect tax from the buyer. Of course, the rate was 1%. So if a car exceeding rupees 10 lakhs is being sold, the seller will have to also collect TCS. This is what the provision is there already. What is changed? A new list of luxury goods have been notified with effect from 22/4/25. What was happening here? Many people were spending or splurging on luxury goods, and now the government wants to confirm, is the income adequate to support the amount of expense that they are having? So, what is this list that is given? Let's take a look. Any wristwatch, any art piece like anting, painting, sculptures, everything. Collectibles like coins, stamps, your yacht, rowing boat, canoeing, helicopter. Sunglasses, of course, all your branded sunglasses will come here. Handbag, purse, shoes, sportswear. It could be equipment like a golf kit, ski wear, home theater system, and any horse for horse racing in race clubs or for polo purposes also. Now, please see, all of these lists have an element of luxury items. The aggregate value should exceed 10 lakhs. So if you go to any store and you're buying from them goods, could be one single item, could be a combination of all of these items, but the aggregate amount purchased during the year, if it is more than 10 lakhs, TCS is now going to be applicable even for this. Yes? Overseas remittance. Now this will divide under two parts. Remittance overseas could be for two reasons. One could be a tour or a travel purpose. So you're buying a tour package, overseas tour package. What is the amount here? There is no threshold. So if it is up to 10 lakhs, it is 5%. Beyond 10 lakhs, 20%. Simple. But if you're remitting money outside India, one is your tour and one is if you are remitting money outside India. Now we need to know the purpose. Why are you remitting? Are you remitting it for education purpose? Are you remitting it for medical purpose? Or it could be for any other reason. If you are remitting for medical and education purpose, now we need to know how did you get the money? See, basically all of these TDS and TCS provisions have single agenda. They want to track whether you have those amount of taxable income. Are you paying your taxes on different sources of income? That you're able to splurge, that you're taking a trip abroad, that you're going for education abroad. Yes? So if remittance is done for the purpose of education or medical, what is the source of money they would want to know? Have you taken a loan from a financial institution? If that's the case, no TDS. It's fully exempt. Earlier there was a TDS even here. Please be careful. Now it is fully exempt. So if you're getting money from a loan, yes, we know what's your source. You've borrowed money. But if it is coming from your own fund or any other source, then we have a TCS amount. How much? It is 5% if it is exceeding 10 lakhs, which means if the amount is within 10 lakhs, no TCS. Only beyond that, 5%. Okay, so if it is from any other source, 5% above 10 lakhs. If your purpose is not education or medical, if it is any other purpose, then we are going to have a TCS of 20% over and above 10 lakhs. Again, no amount of TCS till 10 lakhs. Till 10 lakhs, we can still remit. Please note, this 10 lakhs is an aggregate limit, which means during there, if you're remitting for education, medical, or any other purpose put together, we will check this 10 lakhs here. We had TCS on sale of goods, which is now omitted, removed. There used to be a lot of confusion from the buyer and the seller's angle. You should collect TDS or TCS or I should deduct TDS. There was a lot of confusion. So they said, okay, fine. We will omit the TCS part. However, your 194Q would continue. Please remember, TDS on purchase of goods continues as such. There is no change there. There is no difference there. Only TCS is now being removed completely. TCS on sale of goods, okay? Next one, as far as your filing of returns are concerned, there is an important amendment in updated return. You know very well we have an option even after 31st December. For us it will be 26 because we are in the financial year 25-26. So after 31/12/26 also. So financial year 25-26, your due dates would be July for a non-tax case, October for a tax purposes, or your September, October, that will be there. To file your revised return, belated return, also we have time till December. Can we file beyond this? Yes, through the updated return route. You know very well there are certain rules there. We can't file to increase our refund. We can't file to claim more loss. Those things are not allowed. We can increase our income. We can reduce our loss. We can reduce the refund claim made by us. We can increase our tax liability. For all those purposes, we can file updated return. Earlier, this was only 24 months. Now it is increased to 48 months. Okay, so from 31/3/2026, your year gets over. Assessment year gets over 27. So from 27, you get 4 years of time to file updated return. But every year has a different additional tax. All of this is additional tax. Okay, remember that. These are all additional taxes. How much? So the last date that you could have filed without this additional tax is 31/12/26. I'm giving the example only of FY 25-26. If you're filing beyond that, maybe till March, maybe till next year, 31/3/28, 25% would be the additional tax plus interest. So if your tax is coming to additional tax is coming 1 lakh. If you're supposed to pay 1 lakh more because of updated return, add 25% more and pay. This is the meaning of additional tax. Plus the interest because you've not filed it on time. If it is filed from 1/4/2028 to 31/3/2029, it is 50% of tax and interest. Up till 31/3/60, 60%. 31/3/31, 70%. So you can update your return for 4 years. But the additional tax also goes up every year. 25, 50, 60, 70. According to me, this becomes a very important amendment, very likely for a question area. Please make sure you're thorough with this and please make sure you're able to solve problems in this area as well. This is as far as updated return is concerned. Let's move on to the last amendment which we have now, Aadhaar. I'll give you a background before I come to this amendment. So, we know very well that the timeline to link Aadhaar and PAN is over. So now if it is not linked, Aadhaar is not linked, there was an option of giving your enrollment ID, even that is taken away. They only want your Aadhaar now. So if Aadhaar and PAN are now not linked, the consequence is PAN becomes inoperative, inactive. Okay, it's the same thing, inoperative or inactive. Consequence. If your PAN becomes inactive, inoperative, there are many consequences. One consequence is TDS shall be deducted at a higher rate. 20% and in one case even 5%. So this is the consequence. Now what was happening here? Maybe a person has forgotten to link his Aadhaar with PAN. So his tax is getting deducted at 20%. Not just that, even the one who is deducting, he has to now be very careful and deduct also at 20%. So this was causing hardship more to the one who is deducting than to the deducting. So now what they say, let's give some relief here. What is the relief? Relief is if the amount is being credited or paid in the period from 1/4/24 to 31/7/25, if this is a time when the amount is paid or credited, and maybe the PAN was inoperative then, but if they have made it operative within 39/25, even if you deduct tax at normal rate, it is completely fine. You don't have to take up the higher rates here. This is the relief. So if the PAN has become operational from or till 39/25, also if the PAN becomes operative, it is completely fine. Don't deduct at a higher rate. Now, what is the story after this date? What if amount is paid or credited after 1/8/25? They say we'll give a small relief even here. What is it? So if it is after 1/8/25, any amount which is paid or credited, you get 2 months of time to make the PAN operative, active again. Otherwise, higher rate will be applicable. So, if it is after 1/8/28, if there is any amount which is paid or credited, you have 2 months of time to make your PAN active again. If you're making your PAN active again, regular rates of TDS will apply. If not, if it is still continuing to be in inactive state, higher TDS rates will now be applicable. This is how the section now reads. So this is the list of amendments which we have. Please go through all of these amendments and please pay special attention to the slab changes, updated return. There are likely chances of getting questions, even capital gains to bonds which have been added. It is likely to be questioned in sums. They may give you that this person has invested in Housing Urban Development Cooperative Bond. Now you would not even know. Please pay special attention and make sure you give 54 EC deductions there. I hope you all would be preparing very well for your exam. Wishing you the best. If you have any doubts, you can always let us know. Thank you so much.